We're here to present the Silicon Valley real estate market update for the week ending January the 16th, presented Saturday morning, January the 17th. These are the key chapters we're going over with brief description. The first 4 slides is a quick summary. It lasts about a dozen minutes. The overall presentation is about 45 minutes. The last 8 minutes is devoted to the Northern Greater Bay Area, 13 counties, 5 regions. We'll start off focused on Silicon Valley and then get into micro market areas, then compare the different counties in Silicon Valley, Santa Clara, San Mateo, and Alameda County. Let's get in so you better understand the real estate market. Here's the slide that's showing the 3 key components. The first one is the broad purple line, and that's the turnover rate. That's the supply-demand balance. How long does it take theoretically to sell out your inventory one time? The reason I say theoretical is it's never going to happen because there's always new listings coming on the marketplace. You can see it's volatile at the end of the year, and that's because inventory and offers is changing rapidly at this time of the year, but we're basically at 110% of the normal turnaround time. I determine normal as the median for the past 10 years being 2016 through and including 2025. Then I look at 2026 compared to that median. We're 10% slower than we normally are, but Silicon Valley is normally fast, so 10% slower is probably actually healthy. You can see 10% is about where we spend third and fourth quarter of 2025. The next slide is showing the offers accepted, which is more important than inventory because this is the buyers that are willing to commit to making long-term commitments, where a seller cashing out is getting their cash and pulling out of the industry. So it's, they're both equally important, but I put a little bit more weight on offers accepted. You can see offers are right about 80%. That's where it's been since 2024. 2024 and 2025 has been on both sides of 80%. 2023 was down at 70%. So we're missing either 20 or 30% of the marketplace, which is quite significant, especially when you look at the boom after COVID. We were only gaining 20%, and it was only for about a year period of time. Yes, there was a period of time, very short-lived, where we were selling about an extra 50%, but most of the time, and call it even 18 months being generous, you're only 20% above the normal level of inventory. Now we've been at least 20% below the normal level of inventory for 3 full years, so more than double the time of the year at 20% surplus. But there's been a long-term trend in Silicon Valley for fewer and fewer offers to be accepted all the time, even though the number of housing units is increasing slightly year over year. And the reason for that is people are locked in low interest rate loans, which is a recent phenomenon, or capital gains and property tax reassessment. Property tax reassessment has been addressed with Prop 19 to some degree, as far as while the people are living, makes it less desirable when people pass away, but there's no real way around the capital gains unless you want to convert it into a rental property and things of that nature. But offers is running about where it's been at about 20% for long term, so nothing there that concerns me. Also, I want to point out on this vertical green line, to the left of that is the historical data, so you can see all 10 years that I have data for. There's 9 years to the left of the green line, and they're on a condensed scale. You can see that the years are pretty close together. To the right of that green line is 2025, and you can see that the horizontal scale is roughly 2x, twice as wide, so you can see trends as well as the current 2026 data. And the third and final slide of this series is the active inventory, which is also important. As I said, you can see at the end of the year it dipped down, and you're comparing the same dates to the same dates. So we were at 80% of the inventory we normally were, and you can see that basically dropped off right around Thanksgiving. The holidays have been more significant since the pandemic. That may explain the lower level of active inventory. But you can see that both have been coming up the last 3 weeks. And also keep in mind, offers lag behind inventory growth by 1 week. You put a listing on the market this week, you're not accepting offers until next week in the vast majority of the cases. Here now is a summary of 7 key indicators. We're going over, this week is in the middle. Purple line is the current data. We're going back 13 weeks. The first one is the turnover time. So how long is it taking? A quarter ago, it was taking 44 days. Now it's taking 51 days. So your first reaction is it's slowing down by a whole week. When you're only talking about 6 and 7 weeks, that is somewhat significant. But I would caution you, look at the percent of normal. You were 110% of normal, 10% slower, and you're still at 110% slower. So the marketing time, the turnover rate rather, is increasing at this time of the year, and it will increase, it looks like, for 1 more week into the future, and then it will start decreasing. That's the huge advantage of seeing these trends. You can see which way it's going to go. And again, the reason it's going to be increasing is the inventory is coming on the market and it hasn't really been available for offers to be accepted on them for another week. So we need to get to that into some stability before we start reflecting what the market actually is. But 51 days is our current time, 10% longer. The next one is marketing time. This is taking a little bit longer than normal. You can see that your purple line is up right at the blue line, which is the longest you'd expect, which is 49 days, and we're actually at 50 days, so we are slightly above that blue line. This is how long it's taking the long typical seller to sell. What I do is ignore the 50% of the marketplace that basically sells during that first week, because they're going to sell in that first week, regardless of how hot or slow the marketplace is. And then I look at the median of the remaining 50% of the marketplace, which is also the same way of saying I'm looking at the third quadrant. You can see a quarter ago, 26 days. Now you're up at 50 days. So that's a doubling of the time to sell, which is significant. And 50 days is 2 months. That's starting to be a little bit of an inconvenience for the person that's living in their house as it's being marketed. But again, come back and look at the percentage, 102%, so basically normal, and then 128%. So it is taking a little bit longer, about 30% longer than it typically does. You can see typical at this time of the year is 40 days. So going from 40 days to 50 days really isn't that big of a deal. Now we move on to ask price reductions, and this measures a difference between the seller's expectations and market reality. When the seller comes on the marketplace, they look at what is available, they look in the rearview mirror on comps, and they try to anticipate where they think the market is. When you have to do price reductions, that indicates the reality was not as aggressive as you thought it was. Sometimes you see prices actually increase, and that says the market was more aggressive than you thought. And right now we're taking more price reductions than normal. You can see the purple line is halfway between the blue line and the gray line. We're sitting currently at 115% of normal, or 115% price reduction. Normally we're only 0.8%. So it's 50% longer, which is how you get this 46% down here. And you can see a quarter ago, we were at 29% bigger price reductions than normal and 127%. So you're taking slightly smaller price reductions now, but the price reductions that you're taking now, even though they're smaller in magnitude, are bigger than they typically are for this time of the year. And part of the reason with all that new inventory coming on the market, you would expect sellers not to be doing any price reductions. So the number of price reductions decreases. And you can see that by comparing the 126% that it was typically a quarter ago. Moving on to overbidding. This is basically right at the typical levels. A quarter ago, you were overbidding 5%, and 4.9 is what you'd expect. Currently, a slight improvement, we're overbidding 3.8. So it's a lower percentage overbid, but it's an improvement compared to the 3.5% we normally would expect at this time of the year. You can see that the overbidding dips down about 2 weeks into the future, and then it starts ramping up. It's a little surprising to see that the overbidding ramps up so quickly, but you're going from a slow time of the year where escrows tend to be longer to a fast time of the year when they tend to be shorter to make their offer look more attractive. So the delay time is not the typical 4 to 6 weeks that I quote, and that partly explains the difference. Moving on to offers accepted, we can see we were only selling 80% of what we normally do at 2,100. Now we're only selling 800. So that number's somewhere between half and a third of the normal level of inventory, or what we were doing, just offers accepted of what we were doing a quarter ago. And a percent of normal is 81%. So the percentage of normal is exactly where you'd expect it to be, but the volume is way down. But the volume goes down at every time, which is why the percentage stays normal. You'd expect that normal number to increase a little bit next week and then start really increasing as we pull away from the New Year holiday and have more and more new inventory. Also, depending on what the 49ers do with their hunt for the Super Bowl this year, will depend on how soon inventory increases and offers increases. Every distraction takes away from the real estate market, whether it be a holiday, except Mother's Day and Valentine's Day, or something like the local team, the 49ers, being in the postseason. Inventory, you can see that you're 103% of normal a quarter ago, right at normal at 2,600, almost 2,700 listings. Now you're less than half of that at 1,200, but you're at 95%. So you're essentially at the same percentage of normal, but yet your inventory has gone down. And you can see that by looking at tracing the gray line. The gray line is the normal level of inventory. You can see it comes down, and you can see for about the last 2 weeks, or 3 weeks, we've had less inventory than normal, and you can see we're coming back up right now, and that inventory levels will continue to grow as we go into the future. You can see that it starts leveling off right here about 8 weeks in the future, about 2 months down the road. And finally, just out of curiosity, transactions. The reason I say curiosity is this is what the industry runs on, but transactions are a percentage of the number of offers. That percentage varies as the TFTs become more or less common. but you can see that we were selling almost 90%, closing almost 90% of the transactions just a quarter ago. And now that's down to only 65%. That is a significant drop, but that's a lagging indicator. I would be more focused up on the offers, which are doing fine. It looks like there's a timing delay. And I think part of that is simply with New Year's and Christmas being on Thursday, a lot of people treated it like a 2-day holiday than the typical big 1-day holiday that it typically is from year to year. Here now is the summary of the micromarket data. What you have here is each one of the different micromarkets in the 3 counties. So you have Silicon Valley up here at the top, number 7. Then Santa Clara County is number 10. San Mateo County is 20. And Alameda County is 30. And then the numbers under there are the submarkets in each one of those micromarket areas. Then you have the different metrics going across. The first group is the raw count, what the number actually is. The green highlighted ones up here in the sort of the middle section of the graph are comparing to the 10-year median. And then you have the offers and activity, active listings, which really aren't that significant as far as telling you what the market is. The ratio is, but that's the turnover rate. Then for interest, you have appreciation, and you have the sold price. And in addition to the median sold price in the middle, you have the 10 percentile on the left-hand side, the least expensive you'd expect to find, and the most expensive 90 percentile on the right-hand side of the median. This, for those people who have been following me for a while, I still have the blue for being a buyer's favorite marketplace, red for sellers, but I've added in the green, which is sort of the balance, and you have this blue-green, which is towards the blue side of a balanced marketplace. So I go from a real faint shade of green, for example, right here in the center of the graph at the top at the 99.5. That's basically a pale green. This is a pale blue-green, indicating that it's getting close to favoring the buyer's marketplace. I didn't want to introduce a pale red-green, which would be a yellow, because then that's a 4th color. So I'm trying to keep it somewhat simple, but I appreciate feedback if you like the 3rd color. When you come over here, you can see there's a lot of red and a lot of green balance. That indicates that the market's still aggressive. But when you come over here and look at the green numbers, there's a lot more blue and green. That means even though the market's still aggressive, it's favoring the buyers a little bit more than Silicon Valley typically has, and that's just in the broad area. And then active inventory across the board almost is green, which is about the normal levels of inventory. And when you see the number, you go from about 95% up to about 130%. And then the appreciation is simply the areas that have seen the most appreciation. You can see the Campbell area in Santa Clara County, as well as Saratoga Las Gatos, has seen the most appreciation. Both of them are very close to 100%. But I also point out, if you look at Silicon Valley, overall, it's 72%. Santa Clara County is 87%. What I was going to try to do is explain why you can have an appreciation rate that's higher or lower than any given micromarket area when you have a shift in the micromarket mix. This is just a summary of the different metrics that you have. Here's some details for those that want to get a little more explanation. Here now is the first heat map, which is the turnover rate. This is just the raw time. You can see that your eastern Alameda County is a cool marketplace. You can see around the bay is a pretty hot marketplace. You can see the expensive areas in San Mateo County are cool, as well as the coast. So you got some hot areas, some cool areas, and they can have hot areas, cool area, normal area right next to each other. And that's why I think it's so important to look at the micromarket areas to understand what's happening in the particular area that you're interested in buying, investing, or selling in. Here now is the turnover compared to the 10-year median. So is it doing better or slower than normal? You can see most of the area is green, so it's doing about the same as normal or cooler than normal. There's no red areas that I'm seeing whatsoever on this graph. So everybody's taking the normal amount of time or a little bit longer. Now this is marketing time. And again, one of the key differences between the theoretical turnover rate and marketing time is marketing time only includes sellers that are successful, where turnover rate includes anybody that was on the marketplace, whether they were or were not successful. You can see that you have a complete color brown range here from deep blue, which would be long marketing times over 6 weeks, to green, which is from 3 to 6 weeks, or red, which is under 3 weeks for marketing time. And again, this is just raw count. What's going to happen when you're in these different areas? Now that's instead of looking at the raw count, you're looking at the area, the number compared to that 10-year median. So again, I go back and look at the 10 years from 2016 through 2025, look at the median for the same dates. What's this week's median compared to that? And then plot it on a percentage basis. You can see some areas like Campbell, Willow Glen, they're selling in half the time, 48% of what they normally do. And in the same county, you have Saratoga Las Gatos, it's selling in 140% of its normal time, twice half the speed to 50% more than speed. Price reductions, and this is the seller reducing their own price before the offer comes in. Red is very little price reductions. From a 0.5% price increase, it does happen to a 0.25% decrease. In fact, you can see up here in Alameda and Berkeley, as illustrated by just the island of the Alameda, it's at almost a full percentage increase. And since most sellers don't adjust the price at all, that means there are sellers that are coming in and doing a 10% price adjust in the increasing direction, because they must be getting so many calls. Now, it could also be a typographical error, but I do try to catch those, and Alameda and Berkeley have been hot for a while. But they also have low appreciation rate, which is interesting. Price reductions over in the Livermore area and is high, as well as Saratoga, Los Gatos, and Half Moon Bay. And again, these are the price reductions that the sellers are doing to entice the offer to come in. Now we're looking at the reduction versus typical. So are they more or less than normal? And you can see there are some areas in broad brushed areas where they're taking more price reductions or larger price reductions than they typically do. But then you also have hotspots like Campbell, Santa Clara, where they're taking less, as well as Redwood City and Portola Valley and the expensive areas in San Mateo County, and even the Bay Cities and even Hayward. You have to pay attention. And this is plotted as, I call it price reductions, but it's really the ratio between the price at the time the offer was accepted to the original price. And that's why these numbers are as big as they are. I probably will replot that to be a percentage of price reductions, but have not done that yet. Here's the frequency of price reductions. So how common is it? And it's roughly similar to the previous graph, but the previous graph is the average. So it is a combination of magnitude and frequency, where this is simply frequency. This graph, it doesn't matter whether it's a 1% price reduction or a 10% price reduction, it's still a price reduction. So it's how common is it? And you can see again, the eastern area of Alameda County, very common, South County, very common, and the San Mateo County coast, very common. But in sharp contrast, the west side of the peninsula, all the way down to 880, basically, going up and west along the bay, has had less price reductions, less frequent price reductions than they normally do. That means fewer sellers are adjusting their price in either direction, actually. Here's the compared to typical. So the green areas are where the price reductions are normal. So even though Morgan Hill, the Elroy, was blue in the previous, that's where it normally is. That's why I want to put it here. Not every micro market behaves the same way. In fact, there's a large difference. Saratoga, Los Gatos behaves completely different than Campbell and Santa Clara. And that's one of the reasons why it's important to look at the micro market areas. Foster City, I'll caution, is a very small micro market area. I think there's 6 active listings with 6 offers accepted. So very small and influenced, but it didn't follow any of the other surrounding areas. And that's why I left it by itself. Here's the average overbid. So, and this is again back to the raw account. So overbidding here is fairly good in the affordable, sort of moderate and affordable areas of both Alameda County and Santa Clara County. More normal in the less expensive areas in Alameda County and in Santa Clara County, and less overbidding along the coast, very blue in color. You can see that it's actually taking a 3% price reduction when the offers come in the door. And, you know, you go down to something like Berkeley, and that's a 14% price increase. So when you go down 3%, up 14%, that's a 17% swing, all within Silicon Valley. Here's the overbidding compared to normal. So you can see a lot of areas are normal. There are a few areas that are hotter than normal. Again, sort of the South Bay ring would be the sort of hotter normal area here, as well as Redwood City up in Santa Clara County. You can see how blue Foster City is. Here's the frequency, so simply how common versus the magnitude of overbidding. You can see that the Alameda County is pretty green, but again, the areas around the bay are pretty red in color or redder in color. This is just the raw count, so this is how frequent overbidding is. It's more common around the bay than as you get away from the bay. Here now is the overbid frequency compared to typical. So you can see less overbidding in almost all the areas. Los Altos Palo Alto, Los Altos Palo Alto is a lot more overbidding going on, 36% more overbidding than it typically has. You can see that the Milpitas and East San Jose is 43%, so 25% less overbidding than normal. You can come down here to Hayward, which I think is actually Menlo Park is the lowest at 58 and 58. They're tied at 58% for all intents and purposes. And appreciation, just where are the areas that are doing the highest appreciation since 2015. You can see sort of the areas that are a little bit further away, south and east of the job centers, or in the case of Alameda County, north and east from the job centers. The San Mateo County has done the least well, and I believe that's related to the pandemic and the increased amount of remote working. Even though the amount of remote working has decreased in recent months, it's still more prevalent than it was before the pandemic. Here now is price only, so you can, and it's based on the median price. You can have changes. But what I find interesting is you look at Cupertino Sunnyvale here and compare that to Redwood City and the Bay Cities area in San Mateo County, which used to be more expensive and now clearly are less expensive. And I was actually surprised by the magnitude. 2.9 million for Cupertino Sunnyvale, 2.1 million for Redwood City, and 2.3 million for the Bay Cities. So Santa Clara and Sunnyvale and Cupertino have really pulled up compared to the San Mateo County areas. Here's offers accepted, and you can see this is only compared to the 10-year median. I don't have the raw count because each micro-market area is a different size, so it'd be hard to normalize it. And you can see you have fewer offers accepted in most of the area. Remember, we're missing about 20% of the marketplace, so blue in a lot of the areas. The only red area is Cupertino Sunnyvale, which is actually having 65% more offers accepted than it normally does at a time when the rest of the valley overall is 20% shortage. So clearly we're selling more homes disproportionately in Cupertino and Sunnyvale, which, because it's a more expensive area, pulls up the median price for Santa Clara County. And here's the number of active inventory, and active is pretty close to normal levels. You can see there's a little bit of a shortage on the West Peninsula area. And again, here's the summary table that we went over at the beginning, so I won't repeat myself here. Here's some detailed information for those that want to continue to learn more about this presentation. Here now is the first graph. This is all of Silicon Valley. After this series of graphs, we'll go into the three counties broken out separately if you want to skip forward, because you might even find that more interesting. Or Silicon Valley overall, you can see the purple lines going up. Very likely we'll do a sharp peak down next week. I think we're at the peak right now, and we're between the normal level and the blue line, which would be a slower turnover rate. So we're a little bit slower than normal. It's a very steep, rapidly changing. So right now, this is a metric that is really hard to judge the market on, but looking at it, I would say it's absolutely normal, nothing to be concerned about. Percentage of normal, here you have the percentage. It's really hard to see on that previous line, so we presented it out. You can see we dipped down to 100% and we're back up to 110%, which is where we've been. And again, this is the turnover rate, how quickly you sell out the market one time compared to the past 10 years. Here's marketing time. This is only the successful sellers. Notice that it turned around. It's sort of following the gray line. The blue line doesn't peak out yet, and the red line doesn't peak out. It'd be really interesting to see if the purple line bounces back up next week, sort of like they did on the gray line did. But basically, it's sort of a plateau on the gray line for a couple weeks in here. Time will tell what it ends up doing. Here's typical time to sell. You can see that we were quite a bit higher. July 1st, we were 80% longer selling time. Then we got back down to normal selling time. Right now, we're running about 30% longer than you typically do. Here's price reductions. And here, this is the metric I actually like. I'm looking at the 97th and a half percentile. How the heck did I come up with that number? When you look at the data, it's very rare that more than about 25% of the sellers are doing any price reduction at all. And it's very common that that number's down around 15% of the sellers are doing a price reduction. So I wanted to get up to the extreme to avoid places where there's no change in the data, so it's more sensitive. But anyway, you can see the purple line is increasing rapidly at this time of the year. I would say is as steep as the blue line and steeper than the gray line, so it may catch up to the gray line, but it's got a fair amount of distance to go still on that. But this is basically looking at the sellers that are taking the largest price reductions. How big of a price reduction are they doing? Right now, they're about 12.5%. And on a $2 million median priced home, 2.5% price reduction is fairly significantly. If I'm doing my math right, that's $250,000. Here now is the more typical number, the average price reduction. You can see there's a huge difference. The average is about a 1.15% price reduction. So less than 1.2% of a price reduction. That becomes almost noise level, in my opinion, because again, if you take that $2 million house, that $250,000 drops down to $20,000, which really is not much. And it's not because the seller's taking a $20,000 price reduction. It's because the vast majority of the sellers aren't doing any price reduction, and the ones that are doing the price reductions are taking those big price reductions. Here's the average ask price compared to normal. You can see that we're a little bit below normal, taking more price reductions than normal, but we're again within that 12.5% range that I consider normal. So basically, price reductions are normal compared to Silicon Valley's normal performance. Here's the frequency of price reductions. Right now, we're taking more than we normally do because we normally be on the gray line. But what is that more than normal? It's about 18.5% of the sellers are doing a price reduction. That means that 81.5% of the sellers are doing no price adjustment whatsoever. It's a little bit more common price reductions favor the buyer, but it's right there in the realm of normal. It's about 6% more than it normally does. Again, it's the frequency. So 6% of 18% is a pretty small differential. Here's overbidding. So this is the competition. This is the median. And I think this is the only slide in my presentation where I do the median overbidding. It's basically right at this seller's ask price. That means half the offers that are accepted are over ask price, half are under ask price. Here is the overbidding, and this is just raw count above and below normal. So this is not a percentage comparison, but this would be zero is you're overbidding exactly the previous 10-year median overbid. We're up about 0.25%, and if I remember the number correctly, and then I guess it was maybe like 3.7% was the normal amount of overbidding for this time of the year, and the amount of overbidding was 3.9. So you have 0.2 of a difference there. That's what this 0.2 of a difference is. So the average overbidding is a little bit higher than it typically is. You can see we were lower, quite a bit lower, or just last year, but right now we're back to a little bit above where it normally is. Here's the frequency of overbidding. You can see we're just slightly over 50%. I'd call that about 51% of the sellers are getting more than their asking price, and that was increased last week. And I'd expect that based on the shape of the pattern going forward, which is why I included, I would expect the purple line to be going up next week. Here's the frequency of overbidding in Silicon Valley. We're right now at 92% of normal. So even though we have 51% of the sellers getting more overbidding than normal, that's 8% less than normal. And that's 8% of the 51%. So something like 55% of the sellers normally would be getting overbid right at this time of the year. Here's the pricing model. You can see pricing is still decreasing, but basically prices have been flat for the last 3 full years and potentially even 4 years. And what's interesting when we get back to the individual counties is to see when the individual counties reach the point of their price that we are at right now. Here's offers accepted. You can see we're having significantly less offers than accepted. We're turning around, and it looks like next week we'll start seeing the number of offers go up as this week's inventory is available to be sold. Here's active inventory. You can see active inventory went up greater than it normally does. So we went from basically on the red line, which is a slight shortage of inventory, to basically normal inventory. And when you look at this, it's basically following the gray line with a little bit of a heavier hit of lack of inventory over the holidays. Here's some more detail for the stuff we're going into next. And this is where I'm comparing the 3 counties. I compare Santa Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray to each other. This is the turnover time. So Santa Clara County is the fastest. Then Alameda County is in the middle, and San Mateo County is having the longest turnover time, the theoretical turnover time. It's just shy of 2 months at 59 3/4 days. This is the time to sell. Now notice that the order is different. San Mateo is in the middle here. Alameda is the longest time. So you can see there is a difference in how these metrics respond, even though they seem like they're very similar in nature. And the fastest one is Santa Clara County, with this typical seller only taking 1 month of 32 days to sell. So going from Santa Clara County at 32 days to Alameda County at 59, it's almost double the marketing time, all within Silicon Valley. Here's the average ask price reductions. You can see in the Alameda County is doing the largest price reductions at about 1.6%. San Mateo County is in the middle, and Santa Clara County is doing the least amount of price reductions at about 0.65% of a price reduction. Here's the frequency. Santa Clara has the least frequent price reductions, where only about 12.5% of the sellers are reducing price. San Mateo at about 14.5%, and then significantly more sellers are reducing their price in Alameda County at just over 25 to 25.5% of the sellers are reducing. So that's 1 in 4 for Alameda County, and in Santa Clara County, it's 1 in 8. Average overbid, you can see Santa Clara County, even though it's got the fastest marketing time, has the least amount of overbidding at somewhere right around 3%. Alameda County, that has the longest overbidding, has the most overbidding at about 4.5%. The most logical explanation is the Alameda County, the sellers are coming on the market, not selling. They reduce their price below where the market is, and then buyers come in and overbid, because normally you would expect the amount of overbidding to be higher in areas that are marketing their properties quicker. Here's the frequency, very close together. San Mateo County is just under 50%. Santa Clara County looks like it's a hair above 50%. And Alameda County has the most frequent overbidding at about 52.5%, 52.25% overbidding. Appreciation, Santa Clara has the highest appreciation. And again, that could be happening because of the hot areas where Cupertino Sunnyvale, which has a median price of almost $3 million, which is above the $2 million for the valley or for Santa Clara County as a whole. So that would tend to pull up the appreciation in Santa Clara County, but you can see that it's got the highest appreciation at something like 87%. And then San Mateo and Alameda County are very close together down here on both sides of 50% appreciation. And that's since the last 9 months of 2015. But there is a significant difference between 50% appreciation and something like 87% appreciation. But again, this is not necessarily a reflection of property values, but of median price. Here is your median price. You can see that Santa Clara County is now slightly above San Mateo County. If I had to guess the numbers, 1.8 million for Santa Clara and about 1775 for San Mateo County. Alameda County is the more affordable at about 1.1 million. Here's on the same information on regular paper. You can see Alameda County is actually a tad under 1.1. San Mateo County is right at 1750 and Santa Clara County is right at 1.8 million. Here's the payments, assuming a high balance conforming loan for the national average. They're going to be in the same order as the payments because you just plug it in the formula. And if you're assuming 80% loan in a formula for property tax and insurance, the order shouldn't change. Here's offers accepted. San Mateo County is the smallest county. Santa Clara and Alameda County are very close together, and they have been very close together the whole 10 years that are showing on the graph at the current moment. Here's active inventory. Alameda County has a little bit more inventory, as it typically does. You can see, even though with the pandemic, they were really even, post-pandemic and even pre-pandemic, Alameda County tended to have slightly more inventory, same number of offers, which explains why Alameda County has the longest turnover or longer turnover rate. Then you have Santa Clara County, and the smallest one, I think I already did that, was San Mateo County, but it's also the smallest geographical. Here now is the offers accepted. I want to point this out. We now have basically 4 weeks in a row now where this year is the second worst out of the last 25. We're not quite there for 4 weeks ago. You're at 1250 versus 1268, but I do expect this 1250 to drop, and it may not make it there, but I do expect it to drop based on transactions that are falling through. And then on the 853, 852, it will absolutely drop. Now, there's a possibility that it will increase for next week because of late reporting, but then it will come down and start dropping. So I'm very confident this 853 will drop below the 852, which was the second worst year, which is why I highlighted this now as the second worst. So we've had the second worst year, again, as far as volume of transactions out of the last 25. Here's the raw numbers for Silicon Valley, Santa Clara, San Mateo, or Alameda counties. You can look at your metric. I actually have two different appreciation rates on here, the 2015 that I have up here and 2020. So you can see that Santa Clara County has really shined since the 2020 pandemic, 31% appreciation, whereas San Mateo and Alameda County are on both sides of 9% appreciation. So the bulk of their difference has occurred right in the last 5 years. Here's some customization I can do for a buyer that would like to work through me for buy a house. Link to the details of the property, map link if that's of interest to you. Great schools, either the performance and or the name of the schools that are attending that property, and commute times and or distances to the time so you can prioritize. Happy to arrange a spreadsheet in any order that works for you. We have been talking about the Silicon Valley real estate marketplace. We will talk more about the Greater Bay Area. And we have the distributions coming up where we look at 3 key metrics and we look at a large, broad cut of the marketplace. Then we finish up with the Greater Bay Area. which I break down into 5 counties and 13 regions. The handout is not up yet. I will get it up by the time the video goes up. So I should say it's up, but it's not. This is the then you type in the green root URL plus the letter H for handout 2026-01-17 for Saturday's date, and you get a 73-page electronic PDF. And this is the long URL from 2 weeks ago. I need to update it, but if I don't have it posted, I don't have the link yet. If you want to join for the presentation Saturday morning live at 9 o'clock, you type in the green root URL in 2026, or type in the longer blue Zoom link. I'm archiving all my presentation on YouTube. The YouTube channel is the blue YouTube link, or you can type in the shorter green root URL. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Happy to discuss your needs, whether you're a seller, buyer, potential investor, or anything else real estate related. Also appreciate feedback on my presentation, whether you like it, what I can do to make it different, whether you like the 3 colors. Also, keep your eye open for any data that doesn't change from week to week, because every once in a while, something goes wrong with my script and data doesn't get updated. There is so much data here, and my timeline for presentation is so quick, there's no way for me to physically check every single data point. I have a lot of bells and whistles in there to notice things if there is a problem, but I would appreciate outside help. Here is the key information on the distribution we're going to go into. Here's the first distribution, which is marketing time. You can see that I go from 50%, and you can see they're all very close together, which is why I only go to 50%. And then I go all the way up to 90%. These are every transactions. You can see how this purple line is starting to get steep. And up here, that means that the market's improving slightly, even though the magnitude's higher. You're starting off on the dotted line, which is a year ago data. And what we're going to do is step through a week at a time for 5 weeks, then 2 weeks at a time to speed it up, and then a week at a time most recent. And the concept here is you're simply looking at where the line went last year, and that's probably where the line this year will go to. So let's step through. You can see the line went racing down to a hot marketplace. There's the hottest right there. Now it's already cooling off. It's already rising slightly, and it'll continue to rise for several more weeks and by weeks. So what you'd expect the marketing time to decrease for the next several weeks as it did last year, and then start increasing once we get further into the year. Now you can see it's just going to bounce around, not really moving one direction or another. So the summers are not really the best time. There was an unusual acceleration that we had this year, and then a re-slow down for the holidays. And you can see it's just going to climb up. Now notice you're already higher down on the left-hand side over here, and that's indicating the market's already starting to improve. So these lines from last week and the last 3 weeks, so it actually looks like 4 weeks, they're all higher. So this is the new inventory coming on the market, disproportionately pulling down the left-hand side of the time frame first, and then it pulls down the upper one. You start working through as the new inventory is on the market for longer periods of time. So that steepening on the right-hand side is very common and an indication that the market's already improving. You don't see the movement here as much as you do the steepness increase. Now we're doing the same thing with price increases or decreases. Here I start off with the 2.5% that I like. Is look at the fluctuation that you have here. It's all over the place, and we go down to 17.5%. Maybe I should have gone down a little bit more, but you can see at 15%, a lot of the numbers are already at 0%. So what I'm looking at the 15% of the sellers that are taking the largest percentage price reduction decrease by 2.5% to get rid of data errors and the real outlying cases. Concept's the same. A year ago, the line was already up here. Currently, the line's down here. So currently, this year, we're taking a lot more price reductions. But watch which way the line goes. Oops. Which way the dotted line goes. And I bet you it's going to be to the red. The up, look at that. Fairly significantly up, lower and lower price reductions. There's the biggest price reductions right there, right around the February 14th and 21st. Then you have the rapid cooling off of the marketplace where you're taking larger and larger price reductions for more and more sellers. And now you're getting to sort of the stable period right there at the end of June. And now look, it's just bouncing around. Now watch, there's going to be an increase, a decrease in price reductions. Right here it is, I think, right there. So you had 2 weeks that were decreased. So you had a little mini speed up in the marketplace. And that does happen sometimes right around September or August timeframe. August tends to be a bad month. September tends to be a better month. Every year is a little bit different. So you can see we're taking significantly more price reductions across the whole spectrum. Last year, for example, only 15% of the sellers are doing price reductions. This year from the previous data, we know it's up to around 20% of the sellers are doing a price reduction. And the last distribution is overbidding. Same concept. You can see the purple line is below the dotted lines from a year ago. So we're starting on the dotted line, but we're taking more price reduction, less overbidding this year. And they didn't go racing up right away. There was about 3 weeks before it did, which is the time lag. They're sort of the hottest at the end of February, beginning of April. But again, you have that timeline, which moves it back into February, which is the hottest time. You're cooling off. And now you're basically at that summer doldrums where you're not going to be moving much since the middle of July. And there's sort of a bottom at the end of August, and it improves a little bit. See that? It's marching up. Happened more with the overbidding than it did with anything else. So the buyers sensed the improving of the marketplace. Now you're in the end of the year holidays. So the buyers really sensed that market acceleration that appeared to be fairly minor and started overbidding more. Now we're going to be talking about the Greater Bay Area, 13 counties and 5 regions. These are the 5 regions and 13 counties, along with some additional notes in case you have any clarifications. Here you're seeing the turnover time. This is the theoretical turnover time in days. And I will point out that both San Francisco and Marin, the cities, and Silicon Valley have increased the most. They're impacted the most by the holidays, and that's just the way it is. Again, this is because of a large increase in inventory coming on that hasn't been able to have offers accepted yet. Here's the time to sell. You can see the run-up in the cities is dramatic. The run-up in Silicon Valley isn't as much, but still this probably the second. You have the same thing going on in Central Valley in the yellow, as well as very little going on in the Central Coast was somewhat significant, and the North Bay was just going up for a longer period of time, but not as steep. So you can see the behaviors are different based on the people that live in those different communities. Here's ask price reductions. I've offset. This would be basically a hot marketplace up here, and these are just arbitrary placement of the lines. A typical marketplace would be up here, and a cool marketplace would be down here at a 1% reduction. I am actually thinking about working through some numbers and looking at the past 10 years and coming up with a ratio and actually defining these based on the market's performance, but I have not done that yet. Here's the frequency of price reductions. You can see Silicon Valley has the least amount of seller price reductions, and some are around 18%, followed by the cities at 32% of the sellers reducing their price. Then you have almost a 3-way tie at between 36% and 40% of the sellers doing a price reduction. So again, a huge difference. Silicon Valley is half of what 3 out of the 5 regions are doing. Here's the average overbid. So you can see Central Coast actually is going in at 2.5% below the seller's ask price. North Bay is going in 1%. So is Central Valley and North Bay are going in 1% under the seller's ask price. Silicon Valley is going in at about 0.8% above, and the same cities is going in at about 5.75%, 5.75% above the seller's ask price. So again, it varies, with the most overbidding being in the cities. Frequency of overbidding. Santa Clara or Silicon Valley actually has the most frequent overbidding. So the magnitude of overbidding in Silicon Valley is less than in the cities, because the cities has a lower frequency of overbidding, but where it happens with a larger magnitude. And you come down here to Central Coast, and less than 1 in 10, 1 in 5 sellers are getting a price overbid. About 1 in 4 sellers are getting an overbid for Central Valley. About 1 in 3.5, something weird like that. 3 out of 10 sellers are getting more than their asking price in the North Bay. Here's the appreciation. The cities in San Francisco has had the least appreciation at 40%. Central Valley has had the highest appreciation. Central Coast is now currently beating out the Silicon Valley. Silicon Valley is in the middle of the pack, number 3 at only 72% appreciation since 2015. So the lower appreciation of Alameda County and San Mateo County pulls down the appreciation of Santa Clara County. If I remember correctly, Santa Clara County by itself was up at around 90% and would have the highest out of the 5 regions that are here. Here's your sold price. Here's where you can go back and look over time where prices have been. And you can see the cities first reached their time first quarter of 2021. Silicon Valley first reached it second quarter of 2021. Central Coast was close in second quarter of 2021, but didn't hit it until first quarter of 2022. North Bay was first quarter of 2021, and Central Valley was the second quarter of 2021. So basically, we're at the level in all 5 regions that we first hit back in 2021. Here's the estimated payments in the exact same order as the purchase price. Here's offers accepted. You can see that Silicon Valley has not turned around. It looks like the Central Valley in the yellow has turned around. Hard to tell where the gray line in North Bay actually is, but it's still going down in the city, still going down in the Central Coast. In the next couple of weeks, it'll be real telling. You can see how every region turns around and starts increasing right after the end of the year. Here's active inventory. It's already coming up in all the regions. 2 weeks ago was sort of the bottom right at January 3rd, and we've been going up since, and we'll probably go up again next week. Here's the raw number. The presentation is slightly different. Now is the current week. The minus 1 week is the percent change from a week ago and the percent change from 5 weeks ago. You have the different metrics across the top. The 13 counties down the side plus the 5 regions are bolded. I've also added in the Bay Area. I do that because the media talks about it. I think it's a complete garbage number, more garbage number than talking about county numbers. But I think with my micromarket data, it's clear that each micromarket acts varies differently. And you need to understand, ideally, you'd like to understand what's going on in the particular neighborhood you're looking at. But then you get into so small of a sample size, you get statistical noise, which is why I group similar priced, similar characteristic homes together in my micromarket areas. And with that, we're finished with the presentation. I'm again Richard Calhoun, real estate broker with Creekside Realty. Happy to answer your real estate needs or anything about statistics. Email is the best way to reach me, but my phone number is there as well, whether voice or text. Appreciate it. Take care. Bye for now.